Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Andrew, welcome to the Mint Equitymaster Investor Hour. Delighted to have you on this podcast. I want to start off as a beat at the Investor Hour, our regular readers know. Tell us a little bit about yourself, going back all the way, where were you born, what environment you grew up, so that we can get to know Andrew Holland a little better than what otherwise we hear of him on the telly once in a while.
Okay, Rahul, first of all, thank you very much. I'm delighted to be here. Thank you for the opportunity. And so I'm originally from Manchester in England, and that's where I was born and brought up. At that time when growing up, I'm a big avid football supporter, so you had only two teams to choose from, Manchester United or Manchester City.
Mm-hmm.
Fortunately, I chose Manchester United, although it doesn't seem that way at the moment. So I was, obviously a keen footballer, but obviously not to get myself into any kind of football team. I wish I could. And really spent all my formative years in Manchester. I think my first job was actually working for a newspaper called the Daily Mail.
Oh wow! Yeah. Mm-hmm.
Now, Rahul, they put me on the horse racing page. Right? If they would have put me on the football page, I don't think I'd be speaking to you today, right? But horse racing was not one of my big interests. So I left there after a while and started off in a local stockbroking, client retail company in Manchester. And you start off as an office junior and you go around all the different departments learning, from operations. Those days, it was, even when I came to India in 97, it was the old certificate and transfer until it got digitized. But so that's how I really started off in investments and got myself kind of interested more in terms of research. And, because we had a local client base, northern client base, we tended to research companies which were more north-based, which, the investors would find more interesting, more local, more everything. Yeah. So that's how I first started. So that was...
If I may just come in, we'll talk about stocks later. Let's talk of horse racing. What was your beat? You were like... You're visiting the stud farms and figuring out who's going to be the next. What do you have in the UK? I don't know, whatever Derby or whatever it's called, yeah. the triple crown or double crown or whatever it's called.
I wish it would have been that interesting. It was more editing of the when you get the list of the runners and the riders. Uh-huh. It's really editing of that to make sure it's correct.
Ah, okay.
If it would have been the football tables, I would have been interesting.
And this was when? This is when you've done all your schooling, college, etc.
Yeah, so this was 1977.
Wow.
Yeah.
The horses in 1977. And then from there you went to stockbroking. And this was, did you do a postgrad? Did you do another degree, or you just...
No, I just did business studies, and you started off as a junior then. I mean, it was really, because it was a retail, kind of a small retail broking company then, that's really where we were. Yeah.
That if I remember well, those late 70s were not the best time for stocks, right?
No, because if you think about it, we'd probably just come out of the oil crisis, right? That was still after the Volcker days of 74. So no, it wasn't a great time. It wasn't a great time in the UK. I mean, we had coal strikes, we had everything. So it wasn't the easiest time to move into broking. But it was a very small. When I say small, it must have been about less than 50 people in the whole organization. So, but it's mainly to retail clients or some high net worth individuals as well.
And that's where you got introduced to researching stocks?
So there was kind of, 3 or 4 areas you could kind of jump into. One was obviously operations, which was more the back office part of settlement. 2 was, the kind of servicing of clients, talking to them on markets and stocks and so forth. Well, the third part was research, which at this firm, they didn't really have research, a research team or a research individual looking at stock. So I just said, do you mind if I do this? And they said, no, go ahead. We'll see how you get on.
Well, and any companies come to mind that you researched and how they turned out?
Oh, they were all awful. I got it all completely wrong. First of all, I forgot about inflation analysis. So you have to, even though you think a company's growing its top line by 10%, you had to strip out inflation first. So I think they were very kind, and they just kind of looked at the notes and said, well, we'll see about it next time. But I think they didn't really kind of put any of their clients into any of the recommendations I made. But it was a good learning curve because you could feel what people wanted, from that.
Yeah, I can imagine going into a firm where there's no research desk, getting your hands dirty. Lucky to have people who allow you to play around, make your mistakes and learn. That that could have been pretty interesting, a learning curve out there, right?
Yeah. So what happened was then I moved to a different broking firm in I think 1981. We did Manchester again, and at that time, sometimes you could just be in the right place, right? And there was something called the unlisted securities market, which was an unusual name because it's actually listed stocks. What it would be like, rather than have a 5-year record, you might have a 3-year track record. But you go onto the unlisted securities market. And there was a whole host of this in the 80s, because as things picked up, there was, from funeral companies to, fitness companies to, come into the market. So the research I was doing then was some of these companies were coming to the market for the first time. And some of them were northern-based companies as well. So, they did very well. So I kind of became known as someone in the north who was following quite a lot of companies which were on this exchange, and that worked well for me because in 1984 I then moved to London to actually set in a very big London ranked research house, and they said, you're in charge of doing small and mid caps, but mainly unlisted securities market, which is where they fell. And that's really the big opportunity that I had, to build a franchise.
Wow. And what I found particularly interesting is that unlisted securities are those which didn't have a full track record. And imagine if that rule still existed, a lot of people who are so-called punting on IPOs and then losing a lot of their money because they don't know much about the company would not really happen.
Yeah, I mean, obviously, some of the I'm going back now. I'm trying to think of. I think at that time there was some kind of tech boom as well, and a lot of companies would just change their name, to have that part of tech in it, and the share price was just going up. The company hadn't done anything new. But what I used to do was I wasn't covering all of the companies, so I'd be very selective and say, in the 20 companies I followed would be ones which I felt would become larger companies in the future, not just remain a small and mid cap. So it's very, you were very careful on what companies you were you were going to follow, because at that time, I've moved a bit more away from the retail investor now to the institutional investor, the mutual funds or the equivalent of mutual funds in the UK, pension funds. And of course, they have their own teams and due diligence and fund managers. So it was really, having to convince them about that. So I should have mentioned that prior to coming to London, though, one of the fun things that I did was I became one of the youngest members of the Manchester Stock Exchange, which then obviously folded and went into London Stock Exchange, passed all the exchange exams, and that was a fun time. Just be able to, because once you've done all of those exams and you pass them and you become a member of the stock exchange, I could walk on the floor in London, not as though I did, and I could actually buy and sell shares with the jobbers or the market makers, as we would look at them today. So it used to be a lot of fun, because sat in Manchester, I would say, okay, I like this XYZ company. You then speak to clients, and the other salespeople would speak to their clients, and then you get the orders. And of course, I was also transacting the orders too on the floor of the exchange by phone, not by physically. But so that was a lot of fun. And I think it gave me a good advantage of what moves share prices. It's not just fundamentals, right? There's a lot of other factors that go into it. So having that feel for how prices were moving, how markets were moving, was very, very helpful to me.
Yeah, I find this interesting because in this day and age, it's become so easy to transact, right? And there is not much output. It's only input, but you're just trying to transact. But I guess when you are on that floor of the exchange and then there's so much more energy and vibes floating around that it's a whole ball game to master and execute. You may have found the stock, but how to execute must be like an amazing skill.
So you go to, let's say there's 3 market makers in the stock. So let's say you want to buy 25,000 shares. So you go and ask for the quote, right? So they say 100 to 102 in 10,000 shares. And you say, okay, what for 25? And then they said, you could tell that they probably didn't want to sell the stock to you. So then you went to the next one, and he was like, I'm now 100 to 101. So in other words, he's happy to give you the stock. So you got to feel for whether anyone was, whether you are buying on the uprise or you're actually, there's a lot of stock behind this market maker, which you can, you're 25, you can probably fill 10 times. Yeah. So it was good in that respect to get a feel for how share prices move and the dynamics behind it.
Yeah, I've seen it once, the whole process in the early 90s in India. Then, of course, we also went electronic and doesn't exist. But that's something that's lost to history.
But it's such fun because you met some real characters on the floor, and I got to because they're all from a lot of them from the East End of London. So they weren't Oxford kind of educated. But could they make money? Yes, they could make money.
Yeah, the one thing I learned in Bombay for the little time I went to the stock exchange over there. I'm saying over there because I'm sitting in Nariman Point and pointing towards the stock exchange. It is. I met a lot of jobbers who made a lot of money because the spread was so high.
Yes,
they had the holding part to keep it on their books. And they were cleaning out, man. They were making a lot of money, more than the guys who were buying and selling the shares.
Yeah. No, I mean, there's many stories I have on that and how how we made lots of money, just by being a little bit smart and not doing anything which is wrong, but just having the. So, for example, if there's one of the companies I followed was being taken over by another company. Now, unless the company acquiring share price was about to collapse, which we didn't think it was, then actually by buying the existing company shares which are being taken over and then having them moved into these new shares, you get a 10% kind of pop, right? Because no one had really looked into it. So I went and said, here's the opportunity. Well, we made a lot of money for our clients. It's very good.
I guess I think that's the thing that the market brought out. There were a lot of inefficiencies. If you were a little smart, you could really make that money. And now we are down to the second decimal of inefficiency. So,
but there's still money to be made. That's for sure.
Of course, 100%. That's why we all are here, right? Because there's money to be made in fundamentals and finding mispriced opportunities. Okay, so from where you set up, went institutional, doing small cap,
Yeah.
mid cap. Then
So
what happened? Then where do you head?
so in the UK, you had something called the Excel research kind of rankings.
Okay.
Which so once a year as an analyst, it's a bit like the Asian Money Survey or the Institutional Investor Survey now. It rolled into that in the end. You'd wait to see if you were ranked or not. And of course, being ranked meant, you got a lot more credibility in the marketplace with institutional clients. And it's kind of that self-feeding thing, Rahul, without trying to be big-headed or anything like that. But, once you get to be the top-ranked analyst, if you say buy, then actually people believe you and the share price goes up. So it's a self-fulfilling part of it. So you wanted to get into the... So my first year in London, I came number 2 in the rankings. And I think up until I left in, which I'll come to, when I moved to Asia, was either 1, 2, or 3. I mean, that's usually 2 and 3, right. And that was so that was a good thing. So I was working for this broking firm, and I moved to another broking firm. So the first broking firm was a company called well, it got changed so many times, but it became NatWest. Okay, NatWest Markets.
Familiar with NatWest, yes.
Yeah. And then I moved to BZW or Barclays Bank, doing the same thing. Mm-hmm. Took my team with me. That was about, when was that? That would have been 88. Yeah.
Wow. Mm-hmm.
Was it 88? Maybe it'd been 87. I can't remember. It's 87, 88. But obviously in 87 was the big crash.
Yeah, right? You can't forget that. Yeah.
Well, I can't forget it, but here's the funny thing, right? I was actually on holiday. I was in holiday in the US. And I had an Australian friend who was staying at my house. So it was like a couple of days before we're going back. So I had spoken to him. So I thought I'd just give him a call to see, how he is and how's the house and everything's okay. And he said, you must be calling because, to see if your roof is still there. I said, what are you talking? And it's when that had that, the UK was virtually shut down because it had this big hurricane or something come through, which blew off a lot of people's houses and everything. And that, the Monday afterwards, so that was a Friday, and the Monday was Black Monday. And so I walked into the office, and the one good thing about not being in the office for the 2.5 weeks before, was that you didn't feel, you knew something was changing. Whereas I think if it would have been that run up, it would have been, oh no, it's okay, it's just a quick market correction. But I took out my red pen on all the forecasts that I had for all the companies and said, I went out to the clients and said, you need to sell now because this is what's going to happen to the housing market or to this sector or to this sector, given these challenges that we see now. So whilst it may not have liked me for doing that, they actually thanked me in terms of at least being honest in terms of what could happen to the profitability of those companies.
Wow. And you attribute this to the fact that you were away from your desk, which gave you a different perspective. That works for a lot of people, right? And you don't even have to be deliberate about it at times. You have to just let it work on its own and it comes to you. Do you believe that? Does that happen to you more often?
Yeah, no. So, I've always been a great believer in taking time off, taking your holidays. I think, if you take any kind of time period, right? So the first week, you're probably still thinking about the markets. The second week, you're kind of saying, okay, I'm enjoying my holiday now. It's okay. What can I do? But then you're thinking about coming back. So you start kind of gearing up again. But if you take an extra kind of 4 or 5 days, so it becomes 2.5 weeks, you're really that last week and a half is purely relaxed because there's nothing else you can do. And you're doing other things. You're looking around wherever you are, whichever country you are. What are the things which are happening there? Which could be a trend that comes to the UK. So for example, I'll give you an example. It's a weird example. But in the 80s, if you remember, AIDS was a very, very big thing, and it started to pick up significantly in the US. And I've been to the US and just came back and said, listen, I think, whilst I'm not saying this will be, something that happens in the UK, but if it does, then I think the trend would be that, condom makers in the UK will do actually very well. And they did. Their sales increased, multifold. So sometimes just being somewhere else gives you ideas of what could be the future for your markets too.
Yeah, and the point you make is so critical, and this is something we touch upon later in the podcast and how the conversation goes. Is it is very important to have a broader perspective. So you may be investing in India, but it's important to have a global perspective because you don't know how it's going to connect. You could get ideas from anywhere, and therefore you should be reading international, you should be watching international, you should be meeting international, traveling international, and somehow it all comes together and works out, and seems to have worked out for you for sure. Wonderful. So where next? So this was Black Monday. You got the call, right? So that's
So that was good. And then I think around that time, or just a bit later, then I moved to Barclays or BZW to do the same industry, which I did till 1992. But in 1991, I went to my head of research in London and said, listen, I this might sound strange to you, but I actually think Asia will be the powerhouse going forward over the longer term. I'd like to work in Asia in research. So fortunately, BZW had quite a number of offices around the region at that time. Asia was kind of pretty much booming, I think, around that time.
Yep.
So they said, okay, let me speak to people in Asia, and we don't want to lose you, but I understand where you're coming from. So he calls me back a few days later and said, the head of Asia is coming over. I think they're thinking about Thailand as head of research. So I said, okay, that's great. So I did, try to find any research I could on Thailand, and so I sounded at least a little bit kind of knowledgeable, apart from knowing it from, actually, I'm not sure if I'd been on holiday. Yes, I probably had been on holiday there once, but didn't really know very much about it, to be honest. Anyway, so the managing director of Asia comes in, and he said, sorry, Thailand, it's gone. We got a head of research. How about South Korea? So I said, South Korea. Now let me think. They had the Olympics there in '88. I absolutely knew nothing about South Korea. Now, there's one of those things you can say, no, I'll wait for the better market, or because obviously the key markets then in Asia were Hong Kong, Singapore. I'm excluding Japan because I'm talking about Asia. Hong Kong, Singapore, and Thailand. Right? Nowhere else didn't really matter. So I said, okay, let me go and look. Now, so I went on a look around, and obviously there was two people in research, and it was a branch. So really, it's the whole thing to build up. And I thought, this, I'm going to give it a go. I don't know what made me just take that leap, because and I'll tell you more about that leap in a second, but it was something which was a very big leap, because not only was I just moving country, I was moving markets where I had no expertise. My son at the time was 1, and my daughter was to be born, which was born in Korea. So it was a big family leap as well in doing it. But it was brilliant, absolutely brilliant, because anything that I'd learned in the UK, I needed to throw in the bin and start all over again. Right? And I just touch on 2 things why that was. One, there was no consolidated accounts in Korea.
Okay.
right? So it's all, individual companies. So you couldn't work out, if a group was making money or not, because it's all different. And net debt to equity, on average, I'm talking about net debt, not talking about gross debt, I'm talking net debt, was 150 to 200%.
Wow.
Right? Now, in the UK, anything that got that debt is going bust, or it needs to have a raise money. In Korea, it was
the norm. Yeah. The chaebols, right? The chaebols or whatever.
Yeah. So, but what fun. I mean, from a research perspective, it was enormously kind of a big learning curve for me.
But here's the $1 billion question. Did you catch Samsung early or no?
So Samsung at that time was very, very small. It's mainly known for semiconductors. So
the memory ones, the low value ones.
Yeah. And so they were very small. I mean, they were always trying to compete with Toshiba in Japan. But I remember going to the Samsung Electronics, which so the tiny part of electronics was semiconductors. The bigger part that they were trying to push was all of these kind of record players and TVs, which were, if you take your kind of if the Japanese TVs were here, and then Korea was down here somewhere, right? Yeah. But their vision was that we will be one of the biggest players in the world. Now, the problem in doing that is that they didn't really care about shareholder value. So they just spent money and so forth. But it was fantastic. And I was very, very fortunate in that, we had good access to the main companies. And because they opened up to foreign investors. So they were very keen that foreign investors were, allowed access, and particularly the research analysts in that respect. So I was I think 1992 was a good time to be in South Korea, in terms of just being able to kind of get access to those companies.
That miracle was still on, right? The Far East, the miracle, all those economies on the eastern rim of Asia was still booming. They had
it was a fantastic time to be in Korea. And
you can borrow all you want, spend all you want, care to who's about the shoulder.
Yeah, well, that's what they did. I mean, the way it worked in Korea was that you would let's say you wanted to do an overseas issue, a GDR issue, then everyone would pitch, right? But part of your pitch, was where the chairman or the CEO would play golf in Scotland, because they love golf. So, I'm being serious. So it wasn't necessarily your capabilities. It was obviously your capabilities mattered, but also your access to St Andrews in Scotland for playing golf. But that's what I'm saying. It was such a great learning curve, because I think if I would have gone to Hong Kong or Singapore or Thailand, I think it would have been not as so much a learning curve, because there's a lot of brokers there. There's a lot of coverage. So I think I was very lucky. The food was fantastic. The people were great. So we had a fabulous time.
The Wild West for you.
It was a little bit the Wild West, to be honest.
And you were there in Korea for how long?
So I actually moved to India in 1997.
So if I have my dates right, 2nd July 97 is when the whole currency collapse started with the Thai baht, and then everyone followed, of course, right? All these, Malaysia, South Korea, everyone followed. And 98 it was Russia. So by then everything was done in that 1 year period, August 98.
Yeah. So here's the funny part. So I was sat in South Korea, and Merrill Lynch came to me and said, would you be interested in building the office in South Korea? So I said, listen, I've just spent 5 years or more doing the same for Barclays, so really kind of got the T-shirt for that one. And then we just had a few drinks and we're just chatting, just generally. And I said to him, he said, one place that's interesting, because I came on a holiday here in 93, 94. And I just relayed the same story that to him. I said, I was walking down the street and I saw all these papers outside, what looked like newspapers outside a garage, a petrol station. So I said, I walked over and it was all IPO, IPO forms. So I said, I said, there's something that will, it has an interest for me in India. That's for sure. Didn't think anything of it. 6 months later, he calls me back and says, you talked to me about wanting to go to India. Well, we just acquired a stake in DSP Merrill Lynch. Would you like to come and head up the research? So of course I said yes. I'll go over and meet them. Met Amendra, Shitin, the whole gang, and it just felt like the right place to be. So I remember just before I came over, I think they changed the government a couple of times actually. Mm-hmm. In 92, I think
that was the period of India's coalition governments.
Yes, so I think the Davy government went in or out. I can't remember now.
There was IK Gujral, there was Devi Gowda, there was a BJP government. 3 governments within 3-4 years.
Yeah. So going back to your currency crisis. So what happened was that Merrill Lynch decided to do a big roadshow of all the people, all the heads of research from Asia would do this roadshow in London, US, and talk about, obviously, their countries, and particularly because of the currency crisis. So I was sitting there very comfortably saying, I didn't know that much about India still, but I had enough to say that, India's, doesn't, there's no currency convertible. It's not the convertible currency is not there, and I said. So there's no kind of run on the rupee, and so forth and so on. Trying to put the safe haven, right? Yep. India story there. Then of course, halfway through, they tested the nuclear bomb.
The BJP government, that's right. Yeah.
So of course the market collapsed. So my safe haven story had gone. On this tour, but it was fun, and worked with a talented bunch of people from on the equity side, both research and sales, and within the first year, within this kind of Asia money institutional investor, we were in the top 3, from nowhere. So. We actually did quite a lot of fun things as well. We were one of the first to. So when I first came to India, the big picture story was infrastructure, right? You think about 97, is everything was about infrastructure. So we said, okay, why don't we go and do this? Why don't we send out people? So we sent out people to look at, is any of this being financed? So who's financing these projects? Is actually been sanctioned or not? Then we send people out to say, is actually that road being built or not, right? So we did the first kind of overall research of, is infrastructure happening in India or not? And of course, clients loved it because no one had really, put their feet on the ground and done the extra work. So that was fun.
Yeah. I think even Equitymaster was around then already. And we realized very quickly it has to be all feet on the ground because what's being reported in the press was not totally reliable. A lot of it is PR. So you had to go on the streets and see everything, whether it's happening or not. So this is where I think you're in India now. And you of course, wrote the whole Far East miracle. You got away from it before it collapsed. And you landed at the beginning of yet another boom, right? The TMT boom.
Yes.
So that was another period you referred to changing the name. 98, 99 was the perfect period to change your name and get a higher valuation. You had to add a .com to it.
Yes, I agreed. But I remember seeing, there's 2 companies that always stand out to me in that time. Actually 3 companies, I should say. So I first went to meet Infosys I think this would have been 98. We were one of the first to do a investor roadshow, or investor, the big investor kind of jamborees that everyone has these days. And we had about 3 overseas clients at that time interested in India. But we went to Infosys to meet them. I don't think they had a campus at that time. I think it was just one building with a.
I don't remember.
And then we met Wipro, and they were. If you remember back in '97 or '98, they were mainly into food.
Yep.
At the time, and they said, no, we're going to move into IT services, and we said, why? You've got a great food business. Now we were wrong, and they were completely right. And the third company I met was Tata, and it's when they were introducing their first passenger car, the Indigo. I think it's Indigo,
Indica. Yes.
So they said to us, why don't you come for a test drive? Which I don't think they ever do anymore, right? So of course we went there with the analyst, and I said, I only want to sit in the back. I don't want to drive it. I only want to sit in the back. The reason I wanted to sit in the back was see how much room it had against a Maruti. And it was spacious compared to Maruti. I said, this is going to take off. And that's how we became known to write one of the first bullish reports in Tata Motors.
Wow. The Indica story in itself is amazing. And,
Yes.
I actually, my family owned that first generation of the Indicas. And you're right. The first feeling you get when you enter is it's very roomy for a small hatchback.
Yeah.
So, okay. So let's talk a little bit about the whole 99 TMT boom bust, right? How were you placed then? And how did you see it unraveling, and how did you deal with it?
So, I think at the time, because India was still, when I say it was on the radar of institutional investors globally, it really was just on the radar. It wasn't, it was more for information. I think there was 2 big clients at the time. There was Capital and there was Schroders, who were the big daddies, right? And if you could break them, I think Jardine Fleming might have been there as well at that time. But it was really minuscule amounts that you were talking about. And of course, our mutual fund industry was still nascent back in then. So it was mainly the retail side, I think, which we weren't involved with, which I think, suffered from this. So I think it was, we would give information, but we weren't, for foreign clients, they weren't so engaged in terms of they had a lot of money in these stocks. So I think we just kind of rode through it. But yeah, we had quite a lot of stocks which were supposed to have been the next darlings, which just never happened. Never happened.
Okay, so let's jump straight to 2006, 7, 8, 9, right?
Just before you do that, Rahul, is what's interesting is that let's go back to 2002, 2003.
Yeah, sure.
If you remember, that was SARS.
SARS, that's right.
Right.
Mm-hmm.
So I remember, obviously people were worried what was happening in India, the numbers in India, and I said, I think more people die generally in a day than they do from SARS in India. So I don't think it's a big concern. But you know what the market PE was at that time?
Probably 8. I don't know.
Exactly. It was 8. You have a great memory. No, it was 8. It was cheap. Indian market was cheap. Mm-hmm. And that's where we went out and we did a lot of work and said, India's cheap, whichever way you look at it. And if you think there's going to be a boom, across emerging markets, then India's going to attract a lot of money going forward. And that's it. So that goes back to that whole move for the economy was really all the hard work that BGP had done, right?
That's right.
In terms of the roads and everything else, which the UPA kind of benefited from, and that whole India shining story kind of came about. So I think we just kind of went on the coattails of everything else that was happening in Asia, and it was a fun time. But I remember saying to someone, I can't remember, said this must have been the Sensex, and Sensex will go to 10,000. I think it was 6,000 at the time. And he said, you're mad, it's never going to go there. And of course, it was there within minutes, right? So it was, again, a great learning curve. There was a lot of interest in India, but it wasn't now India was not on the radar. You had many investors, not just from the UK and from the US, but from Europe, Australia, and obviously the Middle East and Far East.
Yeah. So how did the so-called great financial crisis work out for you over here? Because I think that also overlaps with infrastructure, or the report you mentioned, because in the mid 2000s, there was a lot of money available. A lot of companies leveraged out dramatically, be it real estate, be it the infrastructure companies. Big IPOs, Reliance Power, the mother of all IPOs. And then we had the massive sellout. How were you placed all along in that journey?
So Rahul, just to kind of go back a little bit, in 2006, late 2005 going into 2006, Merrill Lynch took a 90% stake in DSP, if you again remember.
Yep.
And I felt that I was double-hatted at the time. I was looking after research, but I was also the COO. But I felt, I'd rather be in the markets than what it is like, right? Than looking at some legal contract.
Yep.
So I said I want to do something different. So they put me in heading up the what was called the internal hedge fund, and it's part of the strategic risk group, SRG it was called. Which globally Merrill's had about $10 billion of balance sheet money. And they said, can you set up some stuff twofold? One, run a prop, get a team, and we'll give you $500 million to run that. And if you can also build a research team, which will feed into the global guys as well. So that was a mandate. So along with my now co-CEO, Vaibhav Sangwi, Piyush Shah, who worked with me in equities, we all got together in kind of 2006, 2007, started this journey as a hedge fund. Mm-hmm. Now, going into 2008, we were, actually, if you remember, our markets were still good. It was the global markets which had been falling throughout the year. So there was still that kind of optimism and reliance. Infrastructure was always going to be listed. But a few things kind of made us worried because you could see what's happening globally. And this is what you said at the very beginning. You can't just ignore global events. So there's a few events that happened which made us a bit cautious. And of course, as soon as things started to unfold, because at that time, anyway, we're only dealing in futures and mainly futures, single stock futures and Nifty. We just brought the whole book down to cash. Now, yes, did we lose a little bit of money? Throughout the year, we did make money, but throughout 2008. But in that year, we just took a small hit, in the kind of big falls. And what saved us was this, I think. Was that a lot of the broking houses or the CEOs of the broking houses globally were saying, we've looked at this, we've done haircuts to this through our analysts, and we think we've provided enough now. Now, being an analyst myself, I know there's one thing that we don't do is we don't take our big red pen and mark things down so much, right? We just think what's a more rosier, optimistic level it could be. So we were always on the view that markets would actually fall more because there'd be bigger problems going forward. So we were very nimble, and we just were in and out of the markets a lot quicker than we wanted to be, but we managed to, throughout 2008, make some money.
Wow, really? So
Yes.
You actually had a positive year in 2008.
We did.
Wow. Wow. And all, if I heard you right, all bases the view that the analysts are generally optimistic is going to be worse than what they think it will be. And on that view, you said, let's sit on the sidelines.
Sit a little bit on the sidelines, wait to the times when even the markets have moved up, and then we could be a little bit. But if you remember that time, there was obviously restrictions on being short or anything like that.
Oh, yeah, of course, yeah.
So we're very careful. But mainly we made most of our money on the upside because markets would come down so much, and there'd be some action taken, or there will be action taken by somebody. To kind of shore things up, but it was never enough. So you always knew that the markets would come back for more because it wasn't enough for them. So it's really just weaving our way through that without taking excessive risk. You didn't need to take excessive risk at the time.
And were there any indicators other than the belief of that numbers tend to be optimistic? Were there any indicators you guys were tracking that sort of flagged red, and you said, now no matter what our investors expect of us, whatever Merrill Lynch, SRG expects of us, or whatever the others, hedge fund stuff, we're going out. We'd rather hold cash and not make money than to lose it all.
Yeah, because you're working on the balance sheet of Merrill's, obviously, they were happy. If you made some money, great. But if you were just protecting capital, and that's the thing that we remained with us today is, protect capital first. Because then you still have that capital to fight another day. And if you're making 10-12% in the year, that's good enough, right? You don't need to kind of break the kind of win every time. And of course our markets were a little bit more shallow at the time, so it doesn't help you. But again, it was a lot of watching CNBC till late in the night, speaking to my colleagues around the world, finding out what they're thinking, what they're hearing, and taking it from there, really.
Yeah. Okay, now let's jump to the pandemic. How did the pandemic go for you guys? How were you positioned? Because you have a global perspective. So the question really, in fact, I should kick off with that is, did you hear anything in 2019 that something is happening and you guys should be alert?
Yeah, so so if I said to you before that sometimes being away is good, sometimes being away is not so good. And I think what happened is so I'm just I think anything between 2009 to 2020. There was many different things, right? But I mean, generally, just in terms of career-wise, the team and I moved to Ambit, and that was when we first set up the alternative investment fund, or hedge fund, as we call it, Cat3, and then the whole team moved to Avendus in 2017. Just to give you the context of where we are today. So again, I was in the US. I'm always in the US when these things happen, right? And so we were picking up the news of this happening, but we could see this more towards Italy, outside the US. In the US, no one was wearing masks, no one was doing anything. Okay. And so by the beginning of, I think I came back just after the budget, so middle of February at that time, I would have thought. And again, coming through the airports, US, UK, no restrictions, no nothing, no masks. So you're thinking, okay, it's not as bad as maybe it's a SARS, maybe it's a more of a Asian problem like SARS was. So that was your initial thinking, until things started to explode. So again, what we did, Rahul, was that okay, we don't know. We've never been through a pandemic. I know I'm quite old, but I haven't got that old. So we took the fund to 98% cash and sat there.
Again, going back to your core belief, safety first, live to fight another day.
Live to fight another day. The market, I think, was down in that March, was down 30%. and our return was 0.9% negative for that 1 month.
Oh, wow. And when did you start selling, if I may ask? When you landed back in India mid-Feb?
No, I think because I think you went through that kind of trying to gauge. You're thinking, I've just come from developed world, which is not where in mass there seems to be no problems. Italy has its problems. China, we weren't sure of the numbers, and there was this stats coming out, similar to what SARS was back in those days of hospitalizations, but I don't think anyone picked it up. It's going to go so quickly. But as soon as it did, and as soon as we could start to see that in the markets, we said, we're out. We're just going to liquidate and sit on the sidelines and see what happens.
So you'd already been through that process of thinking. So when you got the first flag, you said, let's go and sit on the sidelines. Oh, that's a very, that's a very extreme call. And it's a kind of a career defining move in the sense that it could have proven to be horribly wrong. But here I quote Charlie Munger, and he said the same thing in March 2020. He said that we'll be happier if we come out with more cash at the other end of the pandemic than less. Basically implying this is not the time to be buying. This is the time to be hoarding cash because you don't know what's going to happen. I guess that's what he was implying. So it's a tough call, but I guess if you put safety above returns, this is what you do.
Yeah, and our investors obviously were thankful for that. Now, on the upside, when markets started to recover, could we have made more? Yes, but we decided that we'd do exactly what we did back in 2008, which was there'll be times when markets are looking good and there'll be times when markets are looking bad. Let's pick our moments. Let's be a little bit quicker with our buying and selling. And so in other words, let's just say you like XYZ stock, you would normally hold that for longer. But if you're seeing a 10% return or 15% return in a month, let's take it off the table. We don't know what's going to happen. Because a pandemic was something that we hadn't faced before. You can only go a little bit by history, but this is completely different, right?
Yeah. And when did you start getting back in the market?
Yes, slowly but surely, increasing it. So by the end of the year, we were positive. I mean, it's not as though we'd lost money at all for the year.
I think a lot of people watching in hindsight would think that was not the right move. And they're thinking of the absolute return, but not realizing the risk they carried with them on March just by being fully invested. So if you're knowingly doing that, it's fine. But if you don't realize you carried a lot of risk, then the next time around, the risk could play out and, you could be sitting with massive losses, right?
Yeah. But we do this at many times, Rahul. It's not just the fact that, COVID happened, throughout the years from 2013 to 2000 or today. There's been many times that we've been at high cash levels, maybe not as high as 97, but certainly towards 90, when there's an election, for example, maybe back in 2014, which way would it go? We're not, election experts, right? So again, we'd rather find out from the exit polls so you have that clarity of where you think things are going to happen and then go back into the market. So you might miss. See, I think it's all about it. Does it matter if you lose the first 5% or a little bit more on a big increase of say 20 to 25% of the market? Trying to find the bottom is the most difficult thing to do. So I'd rather much miss out a little bit, but be able to step into the market with confidence.
Yeah, I like that approach. And I think if you've defined it well and you've trained your investors to expect that kind of a sort of follow through, that's perfect. This works well. You carry less risk, and what you don't understand, you stay away from. And predicting the elections, it's become it's a joke, right? Everyone has the number. In 2019, I remember, NDTV does that very popular show and everyone does it. They all were at 210, 220, 230, 240. But by the time the exit polls came, suddenly the situation started changing, and by the time the results came, they changed a little bit more. And we are research analysts, not psephologists, and even
Yeah.
psephologists get it wrong in that sense.
So I agree. So as I said, there's many times, not just so any, there's been big events, time to taper tantrum, when they say the Fed or someone was having to, make a big announcement.
Yep.
We'll just go more to cash because we can sit and wait for that outcome. But I tell you, I want to go back to one episode back in thinking about, again, I wasn't out of the country. Was I out of the country? No, I wasn't out of the country. But
If it is a big event, you were out of the country.
No, well, it was actually. It became a big event because it was 2013. Remember when the currency went from 50 odd to
That's the taper
60?
tantrum. Fragile five. Was it the fragile five period? I don't know what.
It was Greece, right? Greece was a big problem at that time. But I remember I was out and I was talking to a global economist. I said, what do you think about the Indian rupee? And his words were, and I always remember it, India's the Greece of Asia. Right? So with that knowledge of this is how people think about India, once that started to happen, you then think about how does this work? What stock should I be buying? What stock should I be selling or shorting? So it's obvious, right? Anyone who had lots of overseas debt, you would sell. And because they'd be in problems, the banking sector.
Yeah.
What would you buy? You'd buy safety.
Yeah.
IT, pharma, benefits
that's
of
right. That's
beneficiaries of.
Yeah. What I want to emphasize in what you said is interacting with people in different geographies and trying to understand how they think about it. We are so deep in what we are doing that we suffer from biases. And the best way to overcome that is just to open up the world and just try and learn from everywhere. So we have a whole bunch of other questions to go through. So let's get to that.
Yeah.
We spoke of some stocks. We didn't speak of stocks. We spoke of, all the horse racing and the other stuff you were doing, the unlisted. Do you remember your first investment you made and what really happened to it?
I do, and it's quite a funny story. Well, it wasn't funny at the time. So, I mean, I dabbled a little bit, just buying a share here. I didn't have that much money in those days, right? So, with my research, I'd probably buy, a couple of pounds worth of shares just to get a feel of that. But I think my first biggest investment was, a good friend of mine who worked at another broking house in Manchester said, you should buy this company. And his track record was, he wasn't a research analyst. He was more of a, a broker. So I said, okay, so I put a princely sum of £20. I'm talking about the, kind of late 70s, 80s. And there I am. And I remember it's an oil company. And I'm watching the news at 10. And this headline comes up, showing this, this oil company's field on fire. I'm thinking,
you're 20 pounds on fire.
20 pounds is like he's going to be on fire. And it showed this guy in a white suit flown in from Texas called Bruce Hansen, right? Who was supposed to then go and put out the fire. So I phoned up the guy the next morning because it was too late then. And I said, well, why would you tell me this? He said, what's your problem? We bought it because Bruce Hansen is going to put the fire out and the share price will go up. So my first lesson was never listen to anyone else without doing your own homework.
Research, yeah, that's a good point. Good learning. So I was going to ask you, which was your.
But I did make some money from it.
Oh, really? You made money?
Yeah, I think
I put out the fire.
I think I put out the fire. I think after I got a pound gain, I just decided it went up a lot more. My heart was in my mouth the night before.
So that doesn't count as a failure. So I have to ask you the next one. Which was your first big failure in terms of investment that you made?
See, at the time, Rahul, is that when I moved to London, you would never really buy stocks in the companies that you researched. I mean, you could. There was nothing wrong in doing it. But it always, my boss at the time said, let's say you buy these shares today and there's no one buying it, it's fine. And tomorrow they get taken over. What do you think the headlines in the paper would look like with your name on the front page? Yeah, it's not worth it, right, for the amount of money you're going to do. So really, as a personal investment, I haven't. It's always been through mutual funds and so forth. So I can't really say I'm a personal stock investor, but as a research analyst, I was obviously saying you should buy this and buy that and buy this and buy that. So there was plenty of stocks which didn't go right for me. There's a whole handful of them. I mean, seriously.
Let's pick one, a big one.
One which maybe people will kind of resonate with was in the UK. There was a company called it came to the UK. Why it didn't go to the US, I don't know. Called Mrs. Fields. Remember Mrs. Fields cookies?
No,
they did cookies. Okay. They did cookies, and I went and met them. I flew to Palo Alto. I did all of this. I did the due diligence. I did all the work. They had the right locations and they were doing well. But the one thing I missed was that they weren't really on top of what they were doing in the UK. When things went wrong for them, they went very, very quickly wrong, and I didn't spot it quickly enough. And I'm not sure they went bust, but they virtually went close to it before being taken over. So that was a very bad call, because I thought I had it right, and I thought they were the next McDonald's, and of course they weren't.
Happens.
Lovely cookies though.
Yeah, lovely. So you've been at it for 45 years, right? Roughly?
Yeah, around that, yeah.
Have I got that right? Yeah, 45.
Yeah.
So all along this way, you started with horse racing and you've gone on to do all this stuff. Could you define...
That's about me gambling, right? Horse racing.
I keep coming back to that. It's an amazing start. But talk about your stock selection process. What do you think what has it evolved into, and why does it work the way it works now? What do you think are the unique characteristics that you factor in that make it what it is?
So I think there's three parts to being an analyst, right? I'm putting my analyst hat on, and then I put my kind of hedge fund hat on as well. So when you do a forecast for a company, right? And you show me this forecast. You think the profits are going to be this. I can assure you within the next 1 year, you will change those forecasts 3 or 4 times, right? Because unless you've got hugely great inside information, you've got those forecasts wrong.
Yep.
So as an analyst, I learned that very quickly, in that I'm not going to get it right. I need to get the trend right. I need to get this trend right, and in between, do all the checkpoints to make sure it's happening. Right, in terms of going round, making sure. So, for example, companies in the UK and in India, they say, we got our products in XYZ, Sainsbury's or Tesco's. I would go and make sure that they were, right? So extra due diligence on that. So that's what you can do on this bigger trend, and trying to capture that and saying, okay, I don't know if it's going to be 25% earnings growth. It could well be 50, but I'm not going to go with 50 because I want to do more gradually there. But if you think that, then you're always upgrading. Therefore, you're always giving it a lower rating than it should have really had. Yeah. And that was brought to me by Body Shop in the UK. So I went to meet them, and they were on 140 times PE, right? But if you actually then looked at actual reality, in 2 years' time, that 140p was actually an EPA of 20 because they grew so quickly. So it's capturing that growth, saying that yes, Body Shop will be whatever it's going to be, and knowing that earnings are always going to surprise you on the upside or downside. So I'm a great believer that earnings growth or lack of it will help you with your share price, because it's all about surprising the market. So that's the first thing in terms of, when I'm thinking about analyzing a company. Now, when it comes to then the global factors, we look at three things. In terms of whatever the global growth you're thinking of, but how does that impact commodity prices, currencies, and interest rates? Because all of those three factors will have an impact on India, positively, negatively for the economy, or positively, negatively for certain companies and sectors.
Yeah.
Right. Mm-hmm. So, if you're saying today that, and let's take a scenario, right? We're going to go for deflation, interest rates falling again globally. Obviously, then India would be. What would you buy? Which sectors would you buy? Right? That's the first part. Who's going to be the beneficiary of that, and who's not going to be the beneficiary? So, to my mind, without kind of thinking about that too hard, would be banks, autos, discretionary. Negative, metals, oil. Right? Yep. Because we're saying that global economies collapse, demand has collapsed, and so forth and so on. So that's where I'd probably go in that, thinking about that trade. Now, then it goes back to, okay, within the, let's say the IT sector, who's the best? Who do I want to own and why? Right? Now, let's say we own both Infosys and TCS for this example. One goes up, the one that's going up and not as much. Then I'm thinking only about what's the opportunity cost of me keeping TCS, which has done better, than compared to having a bit more in Infosys. So you're thinking all the time about the opportunity cost. And on the short side, you're thinking about the risk. What's the risk of being squeezed? What's the risk of something changing? And how quickly can I, close that position?
Mm-hmm. So if I was So if I was to just go through that again, I think the first point you made on earnings, the importance of earnings, it's you can't be overstated. But I think I like the point you made, which is get the trend right. You're not aiming for the perfect number, but you get the trend right. You do your due diligence and be sure the trend is right. And if you're behind on the number, it's fine. You can always upgrade, and that's fine. But if you do what a lot of analysts do, where aim high and then keep correcting down, you don't want to be in that place. So earnings is critical. So keep a focus on earnings. Global factors. I love the way you put the global factors. Commodities, currencies, interest rates. And it almost, the way you responded sounded like you had a mental model, which is always in place. And someone tells you, this is happening. You're automatically thinking, naturally, these are the causes. Deflation, interest rates, look at banking, autos, discretionary. And I think given that there is so much noise around, movement around, having such a framework simplifies the stock selection process, I guess, in some senses. If you know the pattern is changing and interest rates are going down, and you had to look at, for example, autos, then you're thinking autos then, and then you become company specific. You mentioned Infosys, TCS. The follow-through question I had on that is, do you bet on one horse, or do you take the top 2, 3 to sort of dilute the risk of a company-specific event, because you're really playing a macro theme?
Yeah. So it's not all about me. Obviously, we have a team of fund managers here, so they will have their own preferences. So, they might feel that the momentum or the kind of so there's many other things that you look at. And I don't want to be too stock specific, but let's just taking the auto sector now. Let's just say we like the two-wheelers. So you've got Bajaj, Aisha, XYZ, like TVS, right? Now, when you look at them and say, okay, these are going to be the beneficiaries of XYZ, right? Now, which one should I have? First of all, you'll look at the PEs, you look at the growth, you look at everything else. Then you look at maybe the technicals. Is it overbought? Is it oversold? Is there a lot of FII holdings in there? Would they want, if there's not, would they come in and could they be the extra push to the share price? So you've got to do a lot of thinking as well of where you want to position yourself. And some will be a little bit to do with momentum as well, right? So you're not saying that you have to have all the sector because you don't want all the sector. If you look at any year and the dispersion within the sector, it could be huge, right? It could be one stock's up 100% and one's down 20%. So you don't want to be in the wrong stocks either. So, but what we're doing, Rahul, is that we're being actively managing this fund. We're not sitting still. Even if we think, and I'm going back to, let's say we had Bajaj Auto, let's say the price is 100, and we think it's going to go to 200 over the 1 year. We know it's not going to go in a straight line unless we're very lucky. We know it's going to go a little bit like this. Now, on the downside, I don't have to own it for that month or 2 months in the portfolio. I don't need to have that drawdown. So I could say, okay, it's gone up, it's done well. Now maybe I should be looking at an auto parts company. Right?
I hear you.
So I don't need to marry any sector or any company.
Yeah, and that's where your technicals and momentum and all come into play because they would give you more faster signals as compared to the fundamentals.
Yes.
So yeah, that makes sense. It's a lot more active money management than a typical buy and hold. And mind you, a lot of the viewers are typical buy and hold. So for them, this is at least for them, this is a little different approach. But I think a lot of people have spoken about this. And I think if you have the skill and the time to do it, this is not a bad strategy at all, right? It just requires.
I think I said it's actively managing. You're correct. So when I think about the long only part of it, right? And you can be in the banking sector, but the banking sector is going down.
Yeah.
So as a long-term investor, just one question you should ask yourself. Only one question. My opportunity cost of being in this sector versus another sector is what? That's it.
Yeah. So we had one guest on the Investor Hour a few months ago, and this is exactly how he explained on when to sell. And you sell when you have a better opportunity. You just move the money. You're not wedded to it. You got a better opportunity, just shift the money.
Yeah.
And if you think like that, the selling decision is a lot more easier than getting wedded to the stock and then trying to break from it, which can be emotionally pretty painful, right?
But I think the other thing here, Rahul, as well in our fund in particular, is that we do have strict stop loss limits as well, which would mean that anywhere between at 15%. Anything that falls from the cost price by 15% is taken out of the portfolio automatically.
Oh, wow. Well, that's very expected. Yeah.
Yeah. No, so it's a very conservatively run hedge fund. We always have a minimum hedge of 30% at any given point of time. So even if the markets are going up, we'll still have a minimum hedge of 30% because you don't know when market risk is going to come calling on you.
Yeah, you get up in the morning and there's a gap down and, that's when things go wrong. Okay. Your thoughts on portfolio construction, portfolio sizing, etc. Typically, now I know you think institutional, you're thinking your fund. Typically, how many stocks would you have? Typically, is concentrated better, diversified better? I can preempt your answer, but I'd love for you to still speak on that a little bit.
Yeah, we're kind of guided by obviously how we want to run the fund. So it's slightly different than maybe a traditional manager. But on the long side, we can take up to, in terms of a single stock exposure, up to about 10% in a single stock. Typically, I'm saying typically, if you've got high conviction, we start off at that 5-6%, right? And then we'll see where we need to kind of to do that. On the short side, or the hedging, because you get squeezed so quickly, and it can be very painful, right? I mean, you'll see, I'm sure you've seen many times stocks go up by 20% because of the short squeeze. Right? You don't get that short squeeze on the way up. I can assure you, it's only on the way down on the short side.
Yeah.
So there, typically, we wouldn't have more than 1 to 1.5% exposure to any one given stock, because we're not like the West in India. We're an emerging market. You can't say this stock is going up and this stock is going down, because if I did that, well, let me give you an example in the kind of when we looked at doing pair trade. So you might like the steel sector, you say, okay, I want to have Tata Steel because it's the best, and I think SAIL is not so good. Once that sector takes off, SAIL is just going to go like that, right? Because it's high beta, high everything. And you lose money having got the sector right.
And if people are short in that, so everyone's buying, and you can really be in trouble. Yeah.
So that's why we're using this. So let me give you an example. Let's say you give me 100 rupees today, okay, and I fully invest that right this second. I'm going to be 76 long, and 24 short. Right, automatically, that's the 30%. Now, on the short side are going to be those sectors and companies which we believe, for whatever reason, are going to be laggards. They might rise in a market which moves up, and that's why you actively manage it. But once market falls, our experience over the last 15, 16 years is that it's these sectors and companies that fall a lot quicker, because there's no fundamental reason to have them anyway at that time. And it gives you that cushion to see what's the risk I need to do. Do I need to increase my longs? Do I need to decrease my longs, increase my shorts, or go to cash? Those are the decisions you need to make.
Got it. We spoke about selling a stock. Do you have any thumb rules for exiting a stock?
No, it really, because of the the market conditions. We always look at if things are going well, go back to the opportunity cost of holding one stock against the other. Obviously, if you bought something at 6% weightage, it's gone to 8. You might say, okay, I want to bring it back down to 6. These decisions are made on a day-to-day basis by each of the fund managers. So
typically, I ask. Sorry.
So I don't think there's any one rule that we have.
Mm-hmm. Okay, fine. Typically, I ask people, how are you teaching your children about money? I know how old your children are. You told me in 1991 they were 1 year and on the way. So let's ask about grandchildren. Are you spending time with your grandchildren and telling them how they should think about money? Are they listening to you? Not listening to you? What's the story?
So my two children that live in the UK are not married yet, so I don't have grandchildren.
Oh, okay.
So I try and I hopefully have imbibed in them how to save, not as though they seem to have listened to that part of it. But what I did for them over the years is that every year I used to buy them one of those gold coins, that you used to get from HDFC.
Yeah.
And then about 6-7 years back, I decided that they were getting a bit bored of gold, and I was not wanting to get any more gold. So I bought Bitcoins for them.
Oh wow! Now the important question is, when did you buy the Bitcoins?
Fortunately, when the price was a lot lower than it is today.
Oh wow, that's a nice call.
Yeah. Now I also have a daughter who's 13. And what I do with her is I've tried to kind of do two things. Well, one is that I do SIPs for her, so she sees that. I make sure she sees that statement every month. I don't think she quite understands that part of it, but when we go away or when we're away, and I say to her. So, for example, I said to her when she was a lot younger, but reminded her, when she's a bit older as well. I said, "Do you remember what time we went to Disney?" She said, "Yeah." I said, "It's fantastic, loved it." I said, "Do you think people will continue going there for blah, 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 blah. I said, yeah, of course. I said, do you think you'll be taking when you're older, do you think so I said, do you think you should buy some shares in Disney then? And that piqued her interest. Well, what, because you can relate to something now.
Yeah.
So I'm saying, don't think just about Disney. Think about, your mama goes to Nike all the time, right? Should we be buying Nike shares, right? So these are the kind of things that, I try and do it through something that she can relate to rather than it's just a financial, look at the fundamentals, come back. I don't think she's ready for that, but I think if she can spot something which is, a trend, and I'm looking for her as being a young kid, right, to tell me these trends going forward.
That's right. I really love the way you the fact that you shared that, because both the way of teaching is nice, and I think storytelling, visual, and the experience matters more at this stage. And the fact that you're looking for tips on what they're doing with them, what they're thinking, is in itself an insight into what could transpire in the future. I think a few years ago, if someone had followed the youngsters, they would have realized the Facebook is dying and the future is Instagram. And now, if you're following the youngsters, you'd realize that everyone's gone onto TikTok, not in India's banned, and Instagram's got a challenge. So there are a lot of themes over there. We should spend more time with our kids and try and catch those themes.
Yeah. I mean, whenever I go out and if I say, do you want to go here? She'll say, no, why would I want to have that brand? Just take me to this brand, please. Okay.
Yeah, that's true. Yeah. Okay. Last few questions. Now you've of course got amazing global perspective. You've lived in multiple countries. You've seen how the economies have shaped up, etc. India's had its moments. In 91, 92, we all believed India's time has come. It was a good start, but it proved to be a false start or a fleeting start. We've been through multiple such episodes. So my question to you, Andrew, is: do you believe? What do you think of India today? Do you believe our time has finally come, like we've been thinking since 1991? And if so, why do you think is different this time?
I'm loath to say it's different this time. I was never, when I was first going to India back in 97, everyone said, India is like an elephant or one of these tankers that moves so slowly and so forth. But I actually don't think it does move that slowly. I think, if I think about, what was it, the first $1 trillion of GDP took 60 years for independence, and the next two have taken 10 years or whatever, 15 years. Now it's quite a remarkable achievement, right? And I think I get frustrated sometimes that India doesn't showcase itself so well. And it's good that I suppose the pandemic happened in a good respect for the fact that we've all realized now there's so much to do in India. We don't need to go, to the Alps, and we don't need to go to Tabletop Mountain. We have all of these things, right? In India, we have palaces. We have lots of things that people don't have. So, so I think here's what my overall view is, and it's a very simple view, is that if I take millennials and Gen Z or Gen Z, there's 450 million of them. It's bigger than China, right? I know where consumer growth is going to come from in the next decade or more. It's not going to be from, yes, it's going to be from the US, but consumer spending, I think in Asia now, is probably as big as the whole of Europe in terms of actual money. Mm-hmm. So is this India's moment? Feels like it, right? It should be. We got opportunities, what the problems that have been happening in China. But my experience from South Korea is that once you get to that per capita GDP of anything towards 5,000, things just boom. Things just boom. And it goes back to the other thing that goes from the UK days was, and we called it keeping up with the Joneses, right? So it was when Thatcher came in and she kind of unleashed all of this buying of council, of government-owned properties or housing. It's a bit like affordable housing here. Now, people started doing that, but when you go to someone's house and you see they've got a nice vase, or you see they've got a nice rug or whatever it is, you want it.
Yep.
You might not want it exactly the same, but you want it. You want to move up. And I think this aspirational India, as well as being I can't get over 400 million people, nearly half the population is under the age of 30.
Yeah.
It's better than China. So I know between China and India, you have all the growth that you need to have.
Yeah.
Now, whether it's China or India, it doesn't really matter to me. But I think when anyone wakes up from the recession that we're facing this year, and they say, where is growth going to come from? It's going to be India, and obviously China, but India.
Yeah, and ultimately the world needs, like if you go back to the basics, land, labor, capital is required for economic growth, and labor is the problem in most parts of the world. And it's got aging societies. They got people who permanently left the workforce. I don't know whether they'll come back or not. But India has no such problems right now. We got plenty of people come, set up shop and do. And I think, I don't know your thoughts on that. If you could share this whole push towards manufacturing in India that started in the last couple of years with the PLI, the production linked incentive scheme or whatever, that seems to be starting to bear some fruit. And so India went agri to services, and we thought we'd done a great job. But what we missed is the middle where all the jobs are created, which is manufacturing. And maybe we are getting that right now.
I think, Rahul, we're probably one of the few countries ever to do that, right?
Yeah, that's true.
Miss out manufacturing.
Yeah.
Listen, you're spot on, absolutely spot on. That is the opportunity. And, if we don't, if we can open our doors up and grab this opportunity, and, for all those companies, even prior to COVID, and we're saying, we need to have some of our risk outside of China in terms of manufacturing. If we can open our doors, grab the opportunity, but also think about the opportunity ourselves, right? If I just take electronics, we're talking about making mobile phones and everything else. Our electronics industry can really take off, not just domestically, but then become an exporter. It's a huge industry. And I think that's the opportunity. And I think Indian companies will grab it with both hands because they can see the opportunity. Yes, the government's providing some incentive to go there. But if the government don't, I think Indian corporates will anyway.
Anyway, okay, that's interesting. We spoke about reading, global perspective. How much time do you spend reading? And if you can recommend some stuff to read, maybe magazines, newspapers, blogs, anything?
Yeah, problem is, Rahul, there's too much to read, right? I get, we get all the brokers reports and strategy reports and global reports. So I must admit, I do less read. Actually, I probably do no reading at all in terms of, kind of economic books. I mean, I'm talking about, you kind of, not normal kind of research reading.
Yeah. Mm-hmm.
But, I think what's important to me, apart from just reading brokers' reports, is actually finding out exactly what's happening. And there's nothing better than that, when I'm phoning up people that and trust and say, how's it going in the UK? Anything happening? How's your gas price? What's been happening there? Get the reality of what's happening, not just this is what you read, this is what you see. I saw some numbers come out, before lunch. I think it was from one of the supermarket stores in the UK. They've actually done well. So people are still spending, and we're all this dire thinking that we're talking about. It's not happening.
Yeah.
To the way we should be thinking.
Yeah. So, pick up the phone and talk. Yep.
Yeah. No, not. I mean, if I could go to the UK, then I'd go and do that. So, it's small things that you do that I did, which gave me an idea. Was there was talk in the UK when the World Cup football was on, right? That people would stay at home because it'd be expensive to go to the pub and watch football.
Mhm.
So I got my spies out and said, are the pubs full or not full? Because that would tell you if people are really spent. Every pub was full.
Cool. Wow.
No one wanted to be home. Yeah.
Yeah. There's nothing like feet on the street research.
I think so.
Okay, my final question to you. I'm literally reading it out now. What is the one idea you would leave for our viewers to think about?
I'm going to leave slightly two ideas, and this is what I really want to kind of emphasize when I think about investments, not just in the fund or individual companies and so forth. So there's two parts to it. One is, that old saying, right? It's not about timing the market; it's time in the market, right? My problem with the time in the market part of it is that because at some point you'll get back to where you were if the market falls, but the opportunity cost you're missing other assets is too high, right?
Yeah.
And so is the allocation of your assets, not necessarily. So let's say you want to put 50% in equities, fine, please do it. But look at that weightage. Should it be a little bit higher? Should it be lower? Year after year, or whatever basis of time you want to, because that will be important to making money going forward. Because everyone will say, I don't think if you've been in the Nifty the last 2 years, you haven't made money, right? If you bought 2 years ago, probably haven't made any money, right? Or very little.
Mhm.
But you would have been through this, right?
Yep.
But if you would have bought housing, you would have made some money.
That's right.
So it goes back to opportunity cost. And the second thing I would say is that, it's the simple things you need to think about rather than if something's complicated and you can't understand it. And I've looked through many balance sheets and cash flows and not understood anything. And if I don't understand it, then I don't want to be in it. And it's sometimes a simple, everyday stuff. You paint your house. Which brand did you use? And why? Do all your friends use the same paint? Why? And that's it's sometimes staring you in the face of where there's a good company, then it's all about just holding on to it.
Yep. And if I may add to that, talk to your kids about brands to find the future winners.
Yes, that was my daughter was just phoning, so I will remind her that she needs to come up with some ideas now.
Yeah, wonderful. Andrew, thank you very much for your time. Been very insightful, very thought-provoking, and thank you for leaving us with all these wonderful ideas.
No, Rahul, it's been an absolute pleasure. It's enjoyable. I mean, taking me back so far as well to my horse racing days. Yeah, but thank you very much. It was an absolute delight. Thank you.
Wonderful talking to you. Thank you.
Thanks.
Pleasure.